even with a power trend that is asymptotically decaying compared to the constant exponential growth, Bitcoin's going to get us to about $550,000, $600,000 by the end of 2030, as you guys know. And gold is only going to get you to $4,500, according to the best possible trend line you could draw for gold.
Hi, everybody. Welcome to our show. Welcome to Best Bitcoin Data Show. My name is Sina. I'm a co-founder of 21st Capital, and my partners in crime are Plan C and Sminson on BBD. And we have a wonderful guest today, Matthew, known on Twitter as One Base Money. He does a lot of interesting economic analysis. He goes on all sorts of podcasts, TFTC, and What Bitcoin Did, the previous one, which is now Mr. Obnoxious, I guess. And he provides, and a lot more, and he provides these regular updates on macro, money, Bitcoin, and all sorts of other things. Welcome, Matthew.
Thank you very much, Sina. Great to be here with you guys. Sminston, Plan C. I've always enjoyed your stuff as well, and since we've teamed up with a couple other things, it's been fun. It's been fun to finally sort of find some folks that really see eye to eye with what I do, some of this data analysis. So it's great.
Yeah, when you do quant work, it can be a little bit lonely, but we're kind of finding our own community. Yeah. So today I want to talk about some of your analyses. Plan C has also done recently very interesting work expanding on quantile regression. Sminson also has very interesting charts to talk about. But I really like most of our focus to be on Matthew's chart. See something about the title of the show, comparing Bitcoin with gold. Because if you look at gold, it's been going up a lot, but Bitcoin has been crabbing for the last few quarters, and that's given us a divergence. And we'll see what Matthew has in mind for that. And also he wants to talk about miners and a few other charts that he has developed. So with that, Plan C, Sminson, anything before we begin?
Let's get rolling. This is great. Great to have you on board, Matthew, and good to be with you too, my partners in crime. I think we should the content that Matthew's bringing has been really engaging and bringing an outside perspective. We've had this kind of quantile regression theme going, which has been a great ride. And yeah, I'd love to get into it.
Yeah, I just want to say, as we're starting out here, just that I'm a big fan of Matthew's work, and I've been following him for a number of years. So yeah, it's really cool to have him on as a guest now. And yeah, he puts out a lot of great content on his YouTube channel. And yeah, lots of great charts, lots of stuff you actually don't see anywhere else, which is unique. So he's got great stuff.
Thanks, guys.
Yeah, kind of amazing the type of people you can find online. So especially like all of you and the broader group, it's very hard to find these connections in real life because there is geography limitation. But okay, excited for our chat today. Let's see what we have. Do you want to share your screen, Matthew?
Yep, I can start out if that's what you guys want. I am sharing at the moment. Should we have an infinite loop here? Can you see this one?
Let's see. Adding.
And did it switch?
Yes.
There it is.
Perfect.
Great.
All right.
I got to say also, I just love the interactive plots from the Porkopolis side. So thanks for bringing that to the table, Matthew.
Hey,
these look great.
Very professional. Very good.
Really good looking.
Yeah.
Yeah.
Someone knew the tech. Who's doing the tech here?
It's been many years coming. This is High Charts, actually. So it's a relatively open source library. You got to work its JavaScript and other things in the background, but it is the library is High Charts. So you can find this stuff yourself, actually, but it will take some coding to get it up to scratch. But anyway, so in light of the title of the show, gold versus some Bitcoin stuff. I just wanted to layer in a different perspective on, and as you guys like to do the regressions, as I do as well, it takes away a lot of the bombast from the space when people just sort of, draw crazy lines and make connections and not doing mathematical regressions. This one I think is interesting because I have this going, of course, the whole life of Bitcoin. All right, this is on linear, right? I'll put it on log in a second. But I also have the gold price going all the way back to its nadir. This means its lowest point since the 1980 peak, which was July 21st of 1999. So it's $252 an ounce. So this actually helps the trend, right? I'm being as favorable as I can because if I'm not showing it, but people can remember, right? Gold peaked in 1980 for about 2 seconds at about $850 an ounce in some places, and then it went into a 20-year bear. So this picks up the bottom of that bear. So it's been very, very helpful to gold. In fact, it's as helpful as you can possibly be for it. So if you just draw the trends, gold is exponential, Bitcoin is power, as we all know on this channel. So I'll put it on log left. This is the left axis, left scales. Gold goes up to $6,000 only using exponential, and the right axis is Bitcoin. The scale is $600,000 on the right axis. So an interesting discrepancy there. But you had mentioned Plan C, that you've seen some other ones that I've done where gold is actually at the higher end of the deviation range. That's true if you go all the way back to 1971. Here I'm actually I'm making this trend line, as I said, right? So I'm starting at the lowest point in the last 25 years. This is really helping the trend line. So here we're actually right on trend. But nonetheless, the deviations, you don't even need to draw the deviations. You can kind of see with your eyes here that, we're at the top end in August 2011 at $1,700 an ounce. And then we went sideways basically for 10 years. Now we're up to $2,600 an ounce. Fine. That's on trend. But this is an exponential trend. And the slope of this curve is something like 9%, if I recall. I don't have it actually on there. It's about 9%, I think, is the slope of this curve. And this is how it looks. And if you let's just take Bitcoin off even. If you take this all the way out to 2030, as we like to do, $4,400, $4,474 an ounce. Then, of course, very simple Bitcoin power curve. You can see how it looks. Log bottom doesn't work so well with this library, so I'm not going to show it. But as you guys know, the slope of this trend at the moment is about 45% per year, even though it looks like it's less aggressive. And of course, we're on a right scale. But you can just see how even with a power trend that is asymptotically decaying compared to the constant exponential growth, Bitcoin's going to get us to about $550,000, $600,000 by the end of 2030, as you guys know. And gold is only going to get you to $4,500, according to the best possible trend line you could draw for gold.
This is an amazing comparative tool, Matthew. I think for a lot of the kind of quote unquote expo bros who throw around the term exponential pretty loosely, this is a good way to distinguish the two functions very clearly. And I think what people should notice here is that even with the exponential function, which you can prove by having a straight line, notice for the audience that the x-axis is not log scaled here. It's only the y-axis, right?
Correct.
So when you have a straight line, in this case, it means it is exponential. But even with the exponential function for gold, you'll notice from the prices that, in 8 years, eight or 9 years, you take it to its conclusion, and Bitcoin is getting close to 1 million, and gold is still just scratching 4,000, right? 4,000, 5,000.
Yep.
So the difference in scale factors there between the two are still huge.
Yeah, it's 84% R squared. Not as good as a Bitcoin fit, but I've run these on so many different things in the markets, and you guys know this as well. Like the financial markets work in exponential primarily because of compound interest. It's just an exponential function, and Bitcoin is not like that.
So based on so you just said based on the trend, the CAGR of the trend, we're looking at a 45 versus 9 is kind of the difference on the trend lines. And so, and when does the convergence happens? It looks like the trend lines, it doesn't mean that's when the prices are gonna, it doesn't mean that's when Bitcoin is gonna flip gold's market cap, but the trend lines are gonna cross, isn't it 2030? I thought I saw you have it where they were gonna cross in 2030. Is that not the case because of the scales?
Different chart. No, that's a different chart. That's on the market cap. I can try to find that for you, actually.
Oh, it's okay. No, it's fine. I mean, we can kind of ballpark what you think it, because I'm sure you kind of know, roughly speaking, when we could see the flipping happen with the market caps. But so with that 9%, that's interesting that it's 9% CAGR, because that's probably what true inflation is. Like, that is probably a way better gauge of true inflation, is like, what is the growth rate of something like gold, because because gold is probably representing that, as well as the S&P, right? If you look at the growth rate of the S&P over the last 50 years, as well as gold, that's kind of a better gauge on the true inflation rate versus this, the stuff, the models they use are just completely, fabricated and manipulated and stuff. So, but yeah, anyways, just my thoughts, but I'll let you get back to it.
So just quick question. You said 9% for gold, right?
Yeah, that's from memory. I got to go back and check this one, but I think that's from again, that's drawing a trend line from the 1999 nadir, the lowest price in the gold bear market to now, as you see. And I'm pretty sure that's the number, but I'm going to try to confirm it here in a second. But yeah, it's something like that. It's maybe 7% if you look since 1971. So again, it's worse. And that's where it gets to what, that's where it gets to what Plan C was saying pre-show. It's like you could even if you go farther back with more data, you could argue that this is actually not on trend. Take away Bitcoin, but this is closer to the upper bound. I'm not showing you here that, but this is the most aggressive you can give a gold trend line. It's very simple. So it's just a very simple observation, but it's the most aggressive way you can do it is find the nadir from 1999 and then draw the trend.
Yeah, I'm much more comfortable considering this 7 to 9% as the inflation rate, not the 2.45 that they feed us. 100%. Yeah, so anything that performs less than this is just is a scam, because somebody is stealing your money somehow in that instrument, right? So the least you should, like, the risk-free rate should be 7 to 9, and if your stocks are performing less than 10%, you're hardly keeping up with inflation.
Yeah, it's 8.9% is the slope of the trend line.
Yeah, I mean, it's interesting because gold really does do its job. I mean, gold's job is just to preserve your purchasing power. Like, it does its job. It's done its job over time. It has these rallies where everyone thinks like, okay, wow, is gold this amazing investment where I'm going to get ahead? Well, I mean, it preserves your purchasing power, but are you going to get rich buying gold compared to, Bitcoin and these other things where, well, no, rich is probably not the right word, but are you going to increase your purchasing power with gold over the long term? Probably not. Are you going to retain it? Probably yes. And then there's a lot of instruments where you can reduce your purchasing power very predictably, like in bonds or whatever. So there's a lot of it's interesting how the game works. The true game, not the game they feed us.
Yep. And you guys know how, like, if you did the slope of the Bitcoin trend over this period, that is let's take off, let's say this and this. If you did the slope of the Bitcoin trend, obviously you see it's growing very sharply. And remember, the scale is, everybody knows the scale is different here. We're on, up to 1 million on the right axis. But if you do just a simple compound growth from the start of the trend in 2010 till today, you're going to get a compound growth of something like 160%, 163%. And of course, that's even higher here. You could be in like the thousands of percent if you caught the trend here in 2010, 2011. And now it is 45%. So still, we're talking 4 to 5 times higher than what the best safe haven asset can give you.
And it's going to be a long time before Bitcoin ever gets down to 9%. I mean, we don't know for sure. Obviously, all these are just models. Like, we do our best to create these models. But like, Matthew has a really good visual on his website. If you go to his website, it's got a it shows basically like a drop from 45% down to 25%, roughly speaking, over the next 10 years, I think it is. And I mean, that's a great tool. He also has a lot of other things there showing like well, he can speak to it, but there's a lot of data in that table he has, just relative to the power law of Bitcoin and things like this. So yeah, it is interesting that yeah, you'll pull it up here. That's exactly what I'm talking about. Yeah.
Quick. So this table, this is the only chart that I have up. I've redone this website many times over the years, but I got I got our good old power trend here with the regression lines. You can see it. This is just monthly. It's a monthly.
If you can zoom in a little bit, because we can use that.
Yeah, let me do that. Where is the zoom here?
Perfect.
Better?
Yeah, it's better. Yeah.
Yeah. Okay. So, you guys all know this trend, and you can see that there, that updates. But then here's a table, and we talked about this actually yesterday, Sina, as well. You can see this last column is very good. It shows you that, if you're taking that, you're taking the slope of the regression coefficient. We know that it's been more or less constant since 2016. And then if you ask yourself, what was the 2016 trend? What price would it predict today? You can see that it's crazy in the earlier years, but really from 2016 until today, you're getting something that's pretty accurate. So that's that last column. And then what Plan C was just speaking to, yeah, the growth rate of the trend all the way out to 2035 here is still 24.4% compounded per year that year. So.
And a lot of people ask, like, I mean, because we all post a lot of this type of content, but the most common question people ask these days, at least in the comment section, for me, is how does this factor in? Like, how does this factor in the increase in the money supply? And will those percentages, or is that just in the model? Like, is that just because I mean we've had an increase in the money supply since this model was created, the power law model. So, like, how does that affect it? I don't know if that's worth speaking to, or we want to get back to the gold stuff. But
in other words, is it worth doing a sort of future inflation correction? Is that kind of what a similar way to ask that, Clancy?
Yeah, I have one actually. I can show you. I hope it pops up correctly.
A lot of people do ask about that.
It's a good question. You guys know I do this. I do this base money survey that I've been doing for about 7 years now, and here is the money supply. Okay, this is the monetary base. I talked about this on the other channel as well. So this is the columns are the jaggedy stuff is what happens on a trailing 12-month basis, and the compound number is the
so explain it, because a lot of people on our channel may not have any idea what this is. So
sure. So
this data was not easy to get. I remember you speaking on another channel. You were saying like you had to pull teeth to get this data. Like they don't want to show us this data. This is unique data. Just so people watching understand, this is not something you're going to see very many places.
Thank you, Plan C. Yes, it has been a slog to get it. This is the culmination of like 8 years of work getting this. I started this. And not even showing this type of detail probably about 8 years ago. But you got to go through every central bank's website. There's the top 50 central banks in the world. It's like 90 countries, 96 countries actually. So 50 currencies. And this is measuring basically the growth of their balance sheet. It's the growth of what's called the monetary base. This is what banks use. This also includes all the cash coin that we know in our wallets, under our beds, whatever. So that's the growth rate of that money supply. So an interesting thing here, you can see if you go back to this area, why was this thing so high, December 1999? This was literally because of Y2K. So people were taking out a lot of cash because they were scared about Y2K. So that, it can be weird things like that. And then it gets back down, and then, 9/11, money supply increases again, so on and so forth. But we see the craziness. Everybody knows that the craziness happened post GFC, post global financial crisis in 2008. So this is a blended weighted average of the 50 currencies in the world. And of course, the euro, the dollar, the yen, and the Chinese yuan are the biggest components of this. But also the British pound sterling is a decent size of it, Indian rupees a little bit.
And is this M0, M1, M2? Which one is that?
This is MB, monetary base. So M0, people confuse MB and M0 all the time. M0 is public facing only. So, and all those M's are public facing only. This includes stuff that the banks can use as well. It's a little bit different. But M0 is a part of this, and M0 is all of the cash and coin that is not in a bank vault, which is the majority of cash and coin. But anyway, that's M0. It's a little bit different. You're going to see similar growth rates, but you're not going to see as crazy a things here because MB includes what's called the bank reserve. And the bank reserve is every bank's account with the central bank. So just like you and I have checking accounts, debit accounts, whatever, demand deposit accounts, they're called in different countries. Every bank in every system, whereas the Federal Reserve System, European Central Bank System, they all have accounts with the central bank. That's called the monetary base because it includes that account, which is called the bank reserve or the master account. So bottom line, monetary base is two things. It's the cash and coin plus all the bank's main accounts. And with those two things, that's how really the rest of money and credit is pyramided on top of those things. So, but this is the reason I do this, and I've been doing it for 7 years, is because this is the most ontological, apples to apples money supply comparable with Bitcoin. Because it's the core, it's literally the core of the system. This is basically the balance sheet of the central bank. It's on the liability side of the central bank. So anyway, that's the growth rate. And if you just want to know a value right now, I'm not showing it on this chart, but it's about it's about $26.1 trillion at the moment.
Matthew, you mentioned I could see using the average across, you said 90 countries, I think. Is there the weighted part, is that based on the country's the actual size of their balance sheets or their GDP?
Correct.
Or
yeah,
okay,
it's just it's not. I'm not mixing anything else into it. It's just the balance sheet, and it is using the dollar exchange rate. So it is true the dollar. It's a Wittgenstein's rule. We don't have to get into this too much, but when a country could print a lot of money, but it could lose a lot of value relative to the dollar, so it might seem weird. Like it might seem like they're actually not printing a lot of money because if you looked at that stock of money in dollar terms, it wouldn't grow that fast, right? Because it's losing purchasing power against the dollar. But what I'm doing, which is the best I can tell, the most like scientific way, is I'm not doing it that way. I'm taking like a huge spreadsheet of all the individual units, all the euros, all the yen, all the yuan, so on and so forth. And then I start there, and instead of taking a straight average, which wouldn't work, I do take a weighted average based on the value of the monetary base each month. But I keep each month separate, so I'm trying to keep it very isolated and very distinct. And it's a different it's a long way of saying it's a different thing than just taking the whole, like converting it all to dollars and then measuring the growth rate of that. That would not be correct. You would be misled even more by the dollar's purchasing power change against other currencies, if that makes sense. It's a lot of data, and you gotta parse through it all. But basically, yeah, this is his best. It's a Wittgenstein's ruler thing, right? I mean, we have 50 different currencies. How do we judge this? But it's the best weighted average that I know how to do it. Bottom line,
it's pretty fascinating. It's a pretty fascinating chart when you look at it, because not only all the data that's going into it and the fact that it's you really don't see this chart anywhere else. It's the average, so you're showing like that 12.7% CAGR. And I mean, going back to the last conversation we were just having about gold, you could argue that this 12.7 is the true inflation rate. I mean, I guess no, because because that would be globally. That'd be like the global inflation. Would you look at that as like the global inflation rate is 12.7%?
Yeah, this is worldwide.
This is like the global inflation rate. So this is like kind of like, I mean, it's going to vary dramatically depending on what country you're in, but this is kind of like the general global inflation rate in actual money printing. And you can see that, like, it's super interesting to see how far and above we've gone below that trend line, because there's been pretty dramatic, and you can see actually the volatility has been increasing, right? Because if you go back, we were relatively, I don't know if that maybe you'd look at it differently. I'm not sure if that makes sense to look at it that way, but
you're correct.
But it actually looks like we're becoming more volatile, not less. So that's actually like, I don't know how you interpret that, but that'd be kind of concerning. But you can see like the dramatic, just in the last 8 years, it's been pretty dramatic. or the last the last 5 years or so, and we're actually quite low right now. Like we're actually so this would indicate we're most likely going to go back to trend here. So like it's looking like we're going to print some money.
And just to one more thing, you mentioned depending on where you are, it could be lower. It's not that much lower. So the dollar is about 9%. So that just shows you right there. One of the strongest currencies, it's 9%. I think depending on the recent data, the Singapore dollar is one of the better ones, and Canadian dollar used to be good. It's not anymore since COVID. They just
not Swiss franc.
Just exploded it. Swiss franc, not either. Yeah, it's unbelievable.
So wait a second. You just said gold grows 9% a year, almost, and you also just said the dollar is devalued.
Devalued 9%.
9%. So those two things are not a coincidence.
Line up quite nicely, don't they? Yeah. And so anyway, this is the reason I showed you this chart, is to get to the question of how does the money supply affect Bitcoin's performance. So what I've done in this chart is I've layered on the Bitcoin market cap trailing 12 months. Now, this is a multiple of 4. So again, they got two axes here. Base money on the left, we're capping out at 40%, and now Bitcoin on the right. So that what you're seeing here, and you'll see it easier on the tooltip, even though I'm capping it, is 160%. But we can then take the power law of that stuff and see how that looks. And by the way, another reason why we can see this is exponential, right, is that it's a straight line. Basically, it's a constant. Exponential is constant growth. So even though on the margin it changes wildly, as you guys see, like we had 31% growth in 2009. This is like QE 2.5, 3. You're at 30% growth here in the base money supply. Overall, constantly at that 12.7% number. If I put let's just keep it with Bitcoin now. We have huge increases here, then we have huge drawdowns in the market cap. Of course, this is dollar terms, right? Market cap, you go down 80%. It's trailing 12 months, so actually it's not. In total, we get to these 75, 80% drawdowns, but as a trailing 12 month, actually, you don't get it there. You get like negative 40%.
Have you run the correlation coefficient on these two like data sets?
No, but it's a good point. But what I wanted to show basically is look at how the money supply is increasing a lot. We're in the QE3 stage here worldwide. Still a lot of money printing, but it starts to actually get aligned in 2019, and people that follow central bank money know this, that like the Fed was trying to normalize during this time, and then they had a huge problem in 2019. The repo market rates spiked, which showed that people weren't happy with what they're doing and didn't feel safe about lending out the reserves. But anyway, we see interestingly that with the coincidence of COVID and the last cycle, these things do line up. So it started to kind of line up the drawdown of Bitcoin in 2018, and then the resurgence in the COVID years and the last Bitcoin cycle, and then the drawdown again, and trying to pull down the COVID inflation actually matched Bitcoin. So it's very interesting that it might actually line up. Coincidence or not, it's hard to say, but it might actually.
It would be interesting. It would be interesting because this does. I mean, it's just visually, it looks like it correlates very highly. It'd be interesting to see, like everyone talks about Bitcoin correlating to like risk assets, which are probably correlated to this. So it's maybe like a second order of correlation, right? So it's like, they're both probably more correlated to this than each other. Like the S&P potentially and Bitcoin, people talk about the correlation there, but maybe they're both just correlated to this. Like it's probably a better correlation, like you said, the base. Who knows? But this is interesting visuals you're showing here, and I mean, there's quite a correlation there. It looks like.
Yep, and then we can also take back to the exponential versus power. So again, the red lines here. This is fiat money world. It's exponential. So the reason that you can draw a nice flat all-time exponential line is because that's how it works out. Even though on the margins, some months are way higher, some months are way lower. We're way lower now because they're trying to normalize still after COVID, but as we know, they just drop rates. Just to finish this up, you can again see the difference here of exponential versus power. If I show you the compound annual growth curve on this market cap trend for Bitcoin,
and I'm going to draw that right now, we see it comes down, which is, remember, this is the opposite of our price curve, right? It's just the compound annual growth of it. So it used to be, on average, you see 155% here in 2011, even though the trailing 12 month was 43,000%. The average, basically the slope of the curve, 144%. We come down, down, down. And interestingly, we're matching this. Take the zoom back out. The all-time fiat trend is 12.7%. And this is as of May, so it's a little bit higher. Don't I have it as of June? Oh yeah, it's as of May. So 51% from May, and it's pretty close to the price curve, as we know. It's going to get closer to that 45% number that we mentioned. But interesting, in that right now we're at about a multiple of 4 volatility over fiat money. Fiat money is volatile as hell. Bitcoin's volatile as hell. But as we know, Bitcoin it keeps going up much higher with each fiat money cycle. And this is interesting that we're hitting this sort of multiple of 4 over the fiat volatility, and perhaps, as Plan C said, we could have some more correlation here in the future.
So you're saying sorry, just to understand that, Matthew, are you saying that the delta of the Kegger difference between this base money percent increase and the Kegger of Bitcoin, that it's like a 4 ratio? Is that what you're referring to? And yes. So are you implying that ratio obviously has changed over the years, and that ratio would be potentially that ratio would in some ways be what the volatility difference is between as well, like the. Or is that a different thing?
It's, I mean, I sort of mix things a little bit. As we know, volatility, of course, measured more by the intraday or intra-month changes, and running standard deviations on that. But it's still a thing that Bitcoin obviously was way more volatile. Now it's less volatile, and the general growth of the market cap in Bitcoin and the total monetary base printing of the world is converging. So that's really what I was saying.
Yeah,
forget
that's an interesting point, though, because there definitely is a trend that the rolling standard deviation for Bitcoin, and it's getting smaller according to a specific trend. I don't know if that's been analyzed for this the money base, though. Has it, Matthew? Is there any consistent trend there, or is it?
I'd say it's even getting more volatile, as we see here.
That's kind of what it looks like to me. Yeah.
It's getting more volatile, and Bitcoin's getting less volatile.
That's so interesting. So interesting that's the narrative is the opposite, right? It's like, but when you look at the data, that's the interesting thing. If you just tune into all these news channels talking about Bitcoin and whatever, you're going to get the narratives, right? But if you actually look at the data, this is where you get the actual real information about what's actually going on in the real world, right? Because I mean, at the end of the day, you could just look at it empirically and say, yeah, it's true, exactly what you're saying. Bitcoin is getting less volatile, and this base money is getting more volatile. That's the trend. It could change, but that is the clear trend.
Yep, 100%.
And they've figured out a way to explode the money supply in the last few decades. In the .com bubble, they still hadn't figured out everything about this QE stuff. And I remember the fiscal how do they say it? Fiscal soundness was a bigger thing. If for a brief moment during Bush administration, they were able to keep deficit down and even have a surplus. If I'm not wrong, if a couple years or 1 year they had a surplus. But then we immediately went back to deficits, and then 2008 happened, and they figured out, there is so many buttons they can push, and so and nothing really breaks, and they can sell it to the public, and expanded money supply after 2008. Then they learned the lesson. 2008 happened a little bit slow. They were still arguing internally to figure it out. But when COVID happened, everything was ready. So they unleashed the bazooka very, very fast, much faster than many other analysts were predicting. I remember many people after COVID were like drawing parallels to 2008, saying it's going to take months before these guys figure out what to do. But they immediately came out with a massive QE program. They were buying anything and everything, not just stocks and bonds, but they were also buying the real estate equity, real estate stocks, right? So pumping essentially the things that wouldn't even need to be pumped, and distributing checks and making all the home values explode, essentially creating this Ponzi scheme, creating this crazy speculation in every asset market. And they've learned this. And as we move forward, they'll be quicker and quicker to unleash the flood of money. So that's the pattern I see here.
Yep. And it's at the end of the day, too, this is where it kind of gets back to brass tacks. This is a dollar creation of what I just showed you. And if I measured it's what I was trying to say before. If I measured the increase of these dollars, it would be a little bit different. First of all, because I don't have all the data back to here, which is okay. But because using my other method, if it's not part of the basket, it's not part of the basket. But here, I'm just calculating it all and putting it all in dollar terms. Regardless, running aggression over it, you can see it's clearly exponential, 99% R squared. And, this is a log scale. And if back to the 2008 that you just mentioned, Sina, the monetary base at the time, 5 trillion globally. The U.S. central bank, the Federal Reserve, was under $1 trillion, all right, at this time. So the U.S. was about 20%, and it still is about 20%, by the way. Now we tapped out at 30 trillion during COVID, and now it's down to about 26.1 trillion as of my last update, which was June. And if you draw this all the way out to 2033, you get about 83 trillion. And this actually, interestingly, could be conveniently, if this sort of number that's made popular by certain people, this $100 trillion number. I'm looking at the next two halvings as when interesting things could happen as far as monetization or hyper Bitcoinization. It's not going to take long to get up to 100 trillion of the monetary base on this 99% R squared exponential regression. It's only going to take 2 more halvings, and you're going to get close to 100 trillion in the monetary base.
The goodness of fit here is fascinating, and it reminds me. I recall there's this graph that you'll see floating around online of it's used in a lot of memes and stuff, but it's you've probably seen it. It's like an exponential decay of purchasing power, and I think they put it in terms of $1,900 dollars in 1900, and it slopes downward. You probably know the graph I'm talking about, but I've actually regressed on that. And you don't even want to trust the data source on that necessarily, but that's even itself a pretty good R squared exponentially. So this is just validating that's actually an even better fit if you take a metric like this and apply that, the monetary base cumulatively, and then, it gives you more confidence that you can probably make some projections using this. So this is great.
Yeah, if you're holding dollars in a bank account, you can literally model your erosion of your time.
Yeah, you want to be. This is if the balance sheet of the central bank is growing at 12.7% blended, or the United States 9%, you better be getting that. That's the main takeaway.
So 401k is doing 10 to 11, 12%. Your real returns are marginal, very marginal. That's a big takeaway.
Yeah, and are your 401ks getting 10%? I mean, that's a pretty big return. It's a pretty large return for any.
That's optimistic. Yeah, exactly.
Yeah. I don't know. I had this one on the miners, but we're maybe running up into some other charts. So, if
you can go. What do you think, Sina? I don't know. I would like to see whatever you got there, Matthew. I mean, we can. Yeah, okay. Go for it. Just quickly.
Let me run over. Yeah. So one more. This is an interesting one, and I'm going to need your guys' help eventually on this because I think it needs a better fit on the quantiles. But this is one I actually had when I first launched my website in 2017. It's called a price to sales ratio. It's been through many iterations, and it was slowly updating with Google
like just a bad Google API for years. But I had this on my website for years, and now it's going to get back up on my site in a better way soon. It's not up there now, but it's based on this, and this is basically, you can find this anywhere. It's Bitcoin public data, right? This is a rolling miner revenue figure. Okay, so it takes the block reward every 10 minutes. It takes the fees every 10 minutes. What was that in Bitcoins? Okay, let's get the amount over a course of a day in 24 hours. And then that Bitcoin value, let's multiply it by the price that day. Let's do the next day, the next day, the next day. You'll get a stream of total revenue. But then I don't want to look at just the total revenue. I want to roll the trailing 12 month, because that's kind of like as we do in the financial world. That's, we run on calendar years. So what do the miners as a whole, as a system, make on the Bitcoin network? It's academic. It's more academic, right? Because some miners are doing other things, or they're mining on multiple chains or whatever. But it's a figure. And we can see that the peak of this was this is in million, okay, on the left axis. The peak was 16.8 billion, 16,800 million in 2020, the end of 2021. And now it's going back up and having actually a nice little increase since our highs in April. It's about 14.6 billion now. So can we build a multiple on this for Bitcoin and use it as a guide? And of course we can. This is what is actually just done in the regular markets. You just take the market cap divided by this, and you would get something called price to sales. It's the market cap versus revenue. And you see how small it actually is. So it's down there in the dark, the pickaxe there on the chart. Here's Bitcoin market cap. But I'll do the multiple now of these two items, and that's here. And so this, again, is simply just the market cap divided by trailing 12-month Bitcoin network revenue. And it picks the tops very nicely. And as you can see, we're in the middle now. Presumably, we're going to have a higher top. But I am curious if we can, as you guys like to do, find nice bounds to make oscillators. I'm going to draw a 2% and a 98% on this. And let's even put it on log so you can see it even better. So this is, I did a
wow, that's actually really good. That's actually pretty good. The way, it's interesting.
Yeah, this is a power regression of the price to sales ratio.
Okay.
It's not a great R squared. It's something like 2/3 is 67%. Yeah.
This is cool. Thanks I'm glad we dove into this. I'm seeing elements of sort of like a standard deviation based. Some of the metrics I think we've been playing around with, like Plan C, I know you've seen. Other interesting thing, I immediately hone in on the 2021 peaks.
Mm-hmm.
And it definitely emphasizes that would be the actual deviation from the power law support, and not the highest price peak, which came later in 2021. I think that's really interesting.
Yeah.
Yeah.
But I mean, I have not seen any good oscillators that you can use based on mining. Like, I've never seen really that much useful mining oscillators. This is pretty unique. This is pretty interesting.
Yeah. And we're just, it's really all comes back to this value here. It's just a rolling trailing 12-month of miner revenue.
So what does it say? What does it say for the last few months? Because we had, after the peak, we had a valley, and then we were kind of going back up. What would be the takeaway from this for the future?
The regression is about 70. I'm not showing the regression line itself. It's in the middle. You can imagine, right? It's about 70, and we are at 83.5. So in this metric, we're a bit ahead, but we're obviously nowhere near the top. But again, this is where I need Smithson maybe to help with catching the tops better.
And the tops are tricky to model, as the gang here is very aware of. You start to catch them, I guess. If you look at the upper bound there, you're modeling that with a power law. So that's kind of a part of the discussion, things we're trying to work out on our end. But there's definitely something here. So this is price to sales. Okay.
Yeah, you might want to catch the, in the early years, you might want to move this higher, decay it more like you do out here, and then increase it more, because you can see here the bottom did not catch the 2% quantile really at all. Wasn't even close to it.
Yeah, and that's
suggests it's moving higher.
totally.
Can you just quickly summarize, Matthew, before we move on? Can you quickly summarize exactly what this is showing? So this is this the aggregate revenue of the miners versus the market cap?
By the way, guys, we passed 2,000 live viewers. Right now, 2,060.
Nice.
All right.
Welcome everyone.
Thanks for joining, guys. Thanks for joining.
Yeah. So this the green shaded area is you can find daily values of this or per block values on some, I think like mempool.space and stuff, but it's the I'm showing you the trailing 12-month block reward and fees in dollar terms. So obviously you have to find those things first in Bitcoin terms, but then you have to find that the dollar exchange rate is different every day. So you gotta you roll this over 365 days. You're gonna have different prices each day, and you're gonna have different revenue values, and that turns into something that is something like 70 times smaller than the market cap on average. I'm just using the regression analysis there, but so here you see that in 2022 it was $16.8 billion from February 2021 to February 2022 that miners theoretically made. Of course, it's an academic calculation. This is just publicly available. No one knows the exact miner balance sheets and income statements, but you can make a revenue figure for miners based on the data.
It is interesting. Sorry, go ahead. Go ahead. No, you go ahead.
Oh, and then I was just clarify. Price is just raw as price, right? Daily.
Yeah.
Is it daily? So you're using?
I'm just using market cap. This is market cap.
Oh, so market cap. Yeah.
Yeah. It's a per share thing. So you could either go total as I'm doing this, or you could go to price and then divide this network revenue by the amount of Bitcoins in circulation. You could do that as well. But that's price to sales. You either do it on a per share basis, right? Is the economic financial term on a per share basis or on a gross basis. So this is a gross basis. Market cap divided by trailing 12-month network revenue. In other words, price to sales.
It's interesting to look at Bitcoin as a network and like how much money it's generating for these miners, or not necessarily money, but revenue generating for these miners. But you could also factor in, I mean, this is more of an esoteric way of looking at it, but think about the revenue that's generated for so many different companies that are attaching themselves to the ecosystem of Bitcoin. I mean, it would be even a larger pool of revenue generated beyond just the miners. There'd be all these other companies and stuff that would grow over time. But this is great data you have here, Matthew. Is there anything else you wanted to add to it or summarize? Or
yeah, no, that's it. Just to say that it's kind of unique to the Bitcoin world, and we don't know. Price to sales, unlike, say, price to earnings, is something that you cannot compare to other industries. So if you're watching this, dear viewer, and you're thinking, oh, well, like Apple's price to sales is only 4. Yeah, it's true. It is only 4, but you can't compare it because, first of all, expenses are not included in here, and that just changes the picture entirely. And getting a weighted, network-wide expense ratio would be very difficult. Maybe some miners have some idea, but that's very difficult. So it's just, you can't do that. So it's a very unique thing. Perhaps we could look at, some other shit coins and compare, but I'm not really worried about it at the moment. I'm just, this is obviously the premier price to sales ratio in the blockchain industry. And yeah, it's interesting that it's moving pretty much higher. So just to kind of summarize, in the 2013 tops, you were about 60x price to sales. 2017, you were at 100x, and 2022, you were at 160x. So it moves higher. It moves like way higher, the actual market cap, than that rolling revenue each cycle up.
So to summarize, we are close to the fair value here, slightly higher. Correct. But way, far away from the top.
Yeah, as most of our models concur on that, I would say.
Perfect. Great work. Great work. I didn't know about this chart. Thanks for presenting it.
It'll be on the website soon. So
That's porkopolis.io.
IO.
All right.
Correct.
Great analysis. Thanks, Matthew.
Thank you, guys.
Perfect. Okay. So I think, Matthew, if you have any other ideas to
Stop
show, let's do that. Otherwise, we can move on to Sminson and Plan C to see what they got for us. They sent me, a list of charts, so I can see it here. But
you go ahead, Spencer. You go first. You go ahead.
Sure. Yeah. If you want to just pull up my first sort of R squared scalar coefficient plot, zoomed in for if you know the one I'm talking about, Sina. And I think this is why I'm so happy that we're bringing on high value guests like Matthew to get kind of these deep dives into the analysis from an outside perspective. And Matthew, like, all of your work is so detailed and rigorous, and I really appreciate you deep diving into that with us. And I think some of this new metric discovery is really important because we tend to start, living a bit of an echo chamber. So this is great, great for the show.
Thanks.
I'm sure the audience, great audience feedback too. Looks like.
Happy to come back anytime, guys.
Absolutely, we need to. Yeah. So this is. I don't want to. We're running up on the clock, but some of my followers. I'm the smallest account here, but this is an update on a chart I posted. I think sometime in maybe July. And I'm tracking, this is all, I'm basically using the power law, right? Ordinary least squares regression. So I'm doing a regression on the power law for all of the price data. I believe this is daily price data since 2010. And you can see, and this was actually touched on in Matthew's opening to his analysis, is that in the early years, there was a large fluctuation not only in the scale coefficient being like the power law slope, right? If you look at things in terms of log, and you see the straight line, that the slope of that line fluctuated dramatically, and you can see that in the top chart here. And then it kind of acts like a dampened oscillator. In fact, I'm almost certain you could probably use some kind of oscillator model. It's really interesting from a like almost an engineering standpoint. And it stabilizes. That was the original intent of showing this chart, is that as time goes on, the years go on, the strength, or I'm sorry, the slope of that power law stabilizes. And as you can see, since sometime between 2017, 2018, the slope of that has been extremely stable. It's been right around 5.7 with small fluctuations. The fluctuations are getting smaller. And then the R squared is the bottom plot. And this is my takeaway today. This is the coefficient of determination, right? R squared. So this metric is used in statistics to tell you what proportion of the data is explained by using this model. In this case, it's the power law model. So it's the y equals a times x to the b. That b is the slope, right? So this is the strength of the correlation essentially to the model, the explanatory power of the power law model. And it goes from 0 to 100%, so 0 to 1. And so what I did was I updated this, first of all, to October 5th. So this is all from like last week. And if you can see overall, there are clear, huge fluctuations in the early days. So you probably wouldn't have been able to hang your hat statistically on a power law until somewhere around 2015 or some years beyond that. But if you jump to the next, what I did is I just wanted to see, since the last price peak, what have the differences been, or like how, can I zoom in on that green portion? There you go. So this is simply an update for both. The top there being the power law slope. It's dipped a little bit, and so it's the beginning of this chart on the time axis is November 2021. So right when we had the final price peak, right, exactly right there as the last all-time high up until today, which is the very last data point on both of these. So the scale of coefficient dipped a little bit, but as we've seen, these fluctuations, they average out at right around, just above 5.7. So it really hasn't changed much. But the takeaway here is the R squared is still trending since the all-time high. And it's gone from 0. You round up to 0.95, but 0.9469, so about almost 95%. and now we're getting close to the 96% today, just since November 2021. So that's about a 1% difference overall. So it's about a 1%. We've leveled that by about 1% in terms of the strength of the correlation using the power law model. So
the power law model becomes even a better fit as time goes on.
That's the big takeaway. And you see that from the zoomed in perspective, but this is even when you take into account being at the all-time high, the last all-time high, the average ordinary least squares regression will tell you that since then, and we know how much further we have to go to get to the next all-time high. Matthew was just touching on that. And in fact, Matthew's chart also showed 96%. So that's also agreeing with this. So yeah, we're on an uptrend, and it's becoming a stabler uptrend all the time. Pretty soon we'll be above 96% is what this is telling us.
Yeah, this is great stuff. And this is based on the OLS regression. We're also gonna, like Sven said, I'd love to see this with a quantile median. See how stable that slope is. And so for people to understand that top chart there, that's the growth rate of the power law, right? So that's the slope or growth rate. And so it's been stable for like you said, for 8 years. And it's interesting how when Matthew and Giovanni kind of originally discovered it, because they were the first two people that discovered it, it was right around the time where it was actually useful. Like if you guys would have discovered it a few years later, it really wouldn't have been useful. So it was just kind of interesting how you both, because people might not know in the audience, but Matthew independently discovered the power law like within months of Giovanni, very close around the same time. And both of them, it's interesting, like I said, like it was kind of the perfect time to discover it, because that's when the growth rate was stabilizing. They're starting to stabilize, but it's been stable for 8 years, like Spencer said.
Yeah, exactly. So that's pretty much it for this chart. So it's good news, I think, for those of us who are relying, I think, on the fundamental power law to base a lot of kind of our second order analyses. I think it's just showing that it is robust across different models, and it's why a lot of our sort of variants on the price modeling and our predictive models are kind of based on the power law. So it's going to be giving us a lot more confidence to continue doing that. So yeah, any other questions on this? I guess, yeah, to reiterate kind of what Plan C just said, is future work on this is exactly to do the 50th percentile regression on this. And the reason is, the hypothesis here is that, or at least kind of like what I've been making the argument for, is that the 50th percentile regression is probably a better fair value metric than tracking the OLS, just because there's the heteroscedasticity. That's a big technical term, meaning that there's a change in the standard deviation. There's a change in the deviations or the residuals from the average trend over time. Median is robust against that. So where you have a lot of these large bubbles, where you have a large price peak relative to the power law, the median is kind of like robust. It's less sensitive to that. So it'll give you a steadier long-term kind of fair value trend. And so the hypothesis here is that you'll actually see less fluctuations here.
Yeah, essentially the high, like the really extreme price action at the peaks pulls up the fair value, right? But using a quantile or a median 50th percentile, it's basically all saying the same thing. That, like exactly like you said, it's more robust to those outliers at the peak, so it gives you more of like a realistic fair value. And we can quantify that. And do you want to show your chart quickly? It'll actually go really well into what I'm going to show right after.
Yeah, let's use this. This is perfect. So I know we're running up I want Plan C to have time to get into his quantile stuff. This is a chart also I posted around the same time as the other one. I'm sorry, I was losing my mic here. So what I'm showing here, I'm trying to tie together the power law concept here for Bitcoin's price since its beginning, since Genesis. So this is all the price data since 2010 in log scale, as well as the price itself being in log scale. And I'm taking three basic statistics that you learn kind of in Statistics 101, which are measures of quote unquote central tendency for a data set or a distribution of data. and I'm kind of analogizing those. I mean, they're not too much. They're not too far removed from the actual principle of average, median, and mode. And so the OLS is the ordinary least squares regression line. It literally is the average. It's taking the average of all the data using the power law regression model, and it's giving you that trend line as a result. So it's essentially weighting evenly all the data at the tops, all the data near the middle, and all the data near the bottoms. And that gives you that gray line. That's the average value. And I'm showing that in three ways. I'm showing it for the overall price trend in the large plot. I'm showing it for the inset of 2024 in the bottom right. So kind of zoomed in. And then the upper left is actually a frequency distribution of the residuals or the deviations from that average line, that gray line. And so, of course, the gray line can be right at 0. Okay. So, and then the median is the dotted teal, kind of teal looking line. And that's sitting a little bit lower. And you can see, it has a different power law slope in each of those different visualizations. I like the distribution perspective in the upper left hand side because you can see it's moving it a little bit closer to that larger peak in the distribution, but it's not exactly sitting right on top of it. So it's not as easily getting dragged around by the outliers that Plan C was talking about, which would be further up on the residuals plot. And it's actually
so let me add
yeah, go ahead.
add something here if someone's confused about that. So basically, when you run a model like an OLS, it goes through the average. Okay, average can be kind of combining everything and may not actually be maybe misleading sometimes, especially in Bitcoin, because you have crazy price action to the upside. Average might be kind of pulled up, as Plan C was saying, pulled up just because we have crazy peaks. Now, that kind of distorts our understanding a little bit if you solely rely on average. But I'm really excited that you put in both median and mode. When you look at median, it gives us a point at which half of the data is below and half of the data is above. So the median line, the median price of 67 is a place where probability-wise we expect 50% chance that we are we're below 67 and 50% chance we'll be above. So that's kind of like the 50-50 point. But that's not even the mode. So the most likely values are below it. Now, at 43,000 that I see over there, that tells us that most of the time, this is the biggest thing I learned from that part of the chart. Most of the time, Bitcoin is below trend, and that's actually great because it makes a lot of the short-term minded people frustrated. It's slow and crabbing, but then there are all these significant explosions that takes everyone off guard.
Exactly. So,
yeah. And there's quite a delta.
Go ahead.
I was just going to say there's quite a delta between the mode and the OLS. So if someone's expecting the average price to always be at OLS, but the actual most frequent is the mode, there's quite a difference there, like Steve was just saying. So yeah, you could make probably an argument that the mode is the actual fair value or the median, right? You could argue in different ways, but it's interesting. But go ahead.
I think it's just to wrap this up, and I think this sets up nicely going to segue into your stuff, Plan C. But I just wanted probably a more simple way to convey this is that the OLS is a little bit of an overestimate. If you're looking for like a quote unquote fair value, I think there's the best reasons to do that is there are the best reasons to do so in applying the median. Probably versus the OLS or the mode. The mode is by definition the most frequent value. There is a small caveat here. This is sort of a pseudo mode because this is really derived through that frequency distribution, and there were some assumptions made. There's actually a different program that I want to use that will do a true mode regression. I don't think this is too far off, but I just want to make that small caveat. It's the point is that when we're we try to find this support line using the power law. And you can see that if you remove all the bubbles, that there's a lot of data that fits that. that is effectively what the mode is honing in on. It's the most frequent value. The median value makes a good analogy for it is if you have a company and you stack up the salaries, the annual salaries for all the employees at that company, and you rank order them from smallest to largest, you're going to have a few people at the very tippy tops who are, the CEOs and maybe the C-suite who are paid like $1 million a year, right? And maybe somebody $500,000, $600,000 a year. And then in the middle, you're going to have kind of the slope down. At the very bottom, there's going to be a huge amount of people who are paid, like $25,000, $30,000, $40,000 a year. So if the question is like, how do we take this company and we want to summarize like what value best represents what people are paid at this company? Would you use the average where the 5 people who make $1 million a year are dragging that value significantly up? It's probably not a very good representation. So that's kind of the analogy here for the OLS fair value, in my opinion. The median would be the person at the company who is exactly in the middle of the 50% of the employees make less money than them, and 50% of the employees make more money than them. So they're the exact midpoint of all the employees. And then the mode is the person who's significantly further down the bottom of the chain, who makes somewhere around that $20,000, $30,000, $40,000 a year mark. So the most people make around that around that value. But the question is, which of those values sort of represents on the whole what people tend to make at this? So median has a nice mix of robustness and so long-term robustness and representability. So
yeah, I think that's a great analogy that a lot of people can relate to, right? That's a great way to explain it, and it really does highlight the differences between those three ways of looking at it.
So that's it. The only other thing I'd touch on quickly is that I think I want to start representing things more in terms of this distribution in the upper left. I think it's, for me, I'm a very visual person. And when we want to think about when things are hot versus cold in the market, we have our great oscillators that I know a lot of us have been developing. Cena's got his volatility adjusted. But when you look at the residual distribution, the general principle here is that the further you are to the left and more negative, the cooler you are. And the further you are towards the tops, the further to the right on that residual plot you're going to be, the hotter you are. But it's going to tend to revert back to one of these representative lines. And I think the median, at this time this is last week, but 67,700 relative to the price was like around, low 60s. So we were like roughly 10% at a discount, at a roughly a 10% discount for the fair value price was kind of the takeaway here.
Another reason why I like that visual is because you're incorporating a time spent at each of those places, right? So you can see as you go to the right, the amount of time you're actually, because you have frequency there, right? You're showing the
exactly.
Amount of time.
Yeah.
So you're incorporating a time component so people can understand not only the more we go to the right, are we more overheated, but there's a higher probability we spend less time in those places, right? Compared to the other parts of it. So it's a very good visual. I like it. We'll blow it up and make it into like a really good chart in and of itself, probably.
Yeah, I love that. And the only thing I would say is it would even be cool to see the current price on that residual chart, because if people aren't still kind of getting it, the current price is to the left of the median still.
Exactly. Yeah. Yeah. I appreciate that. Yeah. I think that's pretty much it from my end. And yeah, I think that's a good segue. So Clancy, you have your models, which are very related to this. So,
okay, 2,700 views, guys. We definitely can't cut the show at this point with so many people viewing. So let's continue.
I can go for another. I can go for another 5 or 10 minutes, guys. Yeah.
I'll try to go through stuff. I mean, it's really just it goes into it kind of. Segues really well in. So this is exactly, again, what we're speaking to, or what Spencer was just speaking to. So this is the quantum regression. So that 50, so this is exactly modeling what he was just talking about, which is that median way of looking at the fair value. So I actually saw his post, and it inspired this one, because it's something we talked about before as well. But I was like, okay, well, because it's a pretty robust way of looking at the fair value, and I think it's better than the OLS personally for a number of reasons that we've kind of talked about. I was like, well, what if you extend this out, until 2034? And this obviously doesn't guarantee this is where the price is headed. This is just the data. This is the current data, what it shows. So that's all we show, is we just kind of show the data, not financial advice. But essentially, if you extend this this growth rate of the fair value based on that median way of looking at it through the quantile, the 50th percentile, we hit exactly $1 million. And this will fluctuate over time. It is pretty solid though. Like, we're going to actually map out how much this model is fluctuating over time, because we can, like Svensson showed before in some of his charts, we can do the same thing and see how, like, over time, how this is stabilizing. So not only can we model this stuff and show where it's going, but we can actually, figure out, okay, how stable is this model, right? So how reliable is this over time? We can kind of map, is it remaining stable or not? But it goes to exactly $1 million. It's literally just a few $1,000s over $1 million by 2034. And that's the fair value, right? We as you can see, we go above that line and below that line at times. But that's the fair value is basically based on this model, which I think is one of the better fair value models out there. It's saying $1 million 2034. So that's really all this model is showing. Now we could be above or below that line, but that's the fair value. Similar to the stuff that Matthew was showing earlier with gold, it's the trend line, right? It's the fair value, it's the trend line, different ways of saying the same thing. And we are actually converging kind of with less volatility around this line over time. But that's really where we could be we could be above it. I mean, the 99th quantile could be 2 million, right? But the fair value trend line is around 1 million. That's really all this chart is showing.
Awesome. So I got another chart from Sminston. I don't know.
Yeah, I just wanted to this is bringing this chart up, which Plan C put up. Sorry, I was away from my mic. This chart, what I also like about relying on this future fair value prediction line is that I just wanted to throw some context in there, is that some analysis, so something I looked into a couple months ago, was that the quantile regression power law slope value, right, that sort of 5.7 value, it does not change. Something I found was it does not change significantly between the very bottom percentiles, like I think around 3%, all the way up to the 50th percentile, which is what Plan C is modeling and projecting out there. So I think it's another reason to sort of trust that future robust trend line. When you're looking at the support, so basically what I'm trying to say is that the support power law line and the 50th percentile power law line change negligibly. There's almost no change in terms of the slope there. So that return, that scaling coefficient, the scale factor there is essentially identical.
And the pseudo R squared, look at the pseudo R squared. See how it's basically between the 0 percentile up to the 50, it's basically straight across. So it fits the data set extremely well. And then after 50 percentile, almost exactly, is when we start to fall off, which is quite interesting.
Yeah, the slope itself really starts to fall off after the 50th percent, above the 50th percentile. The pseudo R squared.
Oh, sorry, my fault.
No.
I mixed them up. Yeah, you're right.
I knew what you meant. There's a more gradual. This could use more work and focus on, actually, I think, because the pseudo R squared is something. It's just different statistical concept than R squared, which is why it's called pseudo R squared. So that's a little bit. It tells a little bit of these two different metrics together tell us a little bit about the difference in kind of mathematical behavior of the data towards the tops relative to the power law versus the bottoms. But I guess my takeaway, what kind of like in support of Plan C's use of that future trend line, is that when you look at the data between kind of the 3rd percentile all the way up to that median point, it's stable. It's very stable, and the slope itself is very reliable.
Yeah, so, exactly. So it's exactly what you said. This is a great visual. I got mixed up on the looking at the axis and the sides there. Good. But basically, like you said, the slope's stable up to the 50th percentile, and that's what we're using. We're using that 50th. So it's kind of like gives us a little bit more, I guess it gives a little more probability that that last model I was showing, could pan out. So
exactly.
We'll continue to run analysis on it to see how useful that is over time. Obviously, the further you go out, the harder it is. The further you go out, it becomes maybe lower probability that it holds. But yeah, maybe the last two charts, Sina, and then we can wrap it up. I can share my last two, and then we can just. Oh, actually, do you mind going back? Sorry, just really quickly. Oh, do you mind? Sorry about the back noise here. Do you mind going back to this one? So look where we are also relative to the timing. So when I put this out, it was October 3rd. So see how I marked October 3rd in the different 4-year windows, and see how relative to the red line, everyone's thinking we're behind for some reason this cycle. We're literally right on track. Like we're actually ahead compared to the first two cycles. If you look at where we were still below that fair value red line in both the first two cycles. The last cycle, we were pretty much exactly where we are now. We were like 10% below it. So we're literally exactly where we're supposed to be. We got over.
This is what happened, Clancy. This is what happened. Like you look at this one, you see we were below trend for a long time, and apart from this, I guess we were also below trend. But this ETF approval kind of got us to the top, and then we were just correcting back to the expected value, and people are thinking we are in a bad place right now.
Exactly, and also just so people understand, the fact that we went over that fair value line this cycle, that was from an ETF. That was from like actual real value. Whereas the one 2 cycles or the last cycle, see how we went way above that red line? That was the plus token Ponzi in China. That was fake value. That was a complete Ponzi scheme. There was $1 billion Ponzi scheme in China that blew up called the plus token Ponzi. So that initial massive pump out of the bear market was really not sustainable at all. And then plus we had the black swan that brought us way down, right? But this time when we got pulled over that red line, you can see in the previous 2 cycles we didn't really go, or the first 2 cycles we didn't really go above that red line. And then we went above it in the cycle before. It was from the plus token Ponzi, and this one was from the ETF. So I think this one is more sustainable value being pulled forward. And yeah, this last 8-9 months of correction, or last 7-8 months of consolidation has been really healthy and necessary given where we were. And we're exactly, relatively speaking, we're on track compared to every cycle. When you look at it,
the consolidation took us from a position of slightly overvalued to a slightly undervalued right now. So actually, we are kind of getting ourselves ready for another move here.
Yeah, and that goes well into the chart, the other chart. You can flip over now to the other chart. There's another chart that basically, we can talk about the consolidation quickly because it's kind of related to the last chart. Maybe if we flip to the other one. Sorry, Sina, just the other one I had there. That one. Yeah, so because I'm definitely not a TA guy. Like I don't really do TA. I'm not don't claim to be any expert on TA. But this is a very basic way of looking at it. But these are just psychological levels, because I think that Bitcoin is a very sentiment driven market, and like you can just see how people react on X and everyone, right? So it's like it's just funny to see the sentiment shift when we go below 60K and above it. It's like palpable. If you spend your whole day on X, you can really feel it. But look at this. We've basically just gone sideways for really 8 months. I put 7 months, but it's actually 8 months where we've really stayed in this range between 70 and 50, spending the majority of the time between 60 and 70, right? The vast majority. We really only had a couple dips below it. And, right now we're just a bit above 60, I believe. But it's really just 8 months of consolidation, which feels painful for people because they want Bitcoin to go up overnight. But the longer we build a base, the higher we're going to go this cycle. And if you compare it to where we were 4 years ago, it felt way more euphoric this time in 2020, and we peaked early in the 2021 cycle. So I don't want us to be euphoric at this stage. I want us to extend well into next year, if not into 2026. For me personally, if the 4-year cycle stays intact, the later the higher we go, in my opinion. And also, like again, this is like a long consolidation period, which really builds a solid base that I think once we break 80K, it's just my take. Not financial based. I'd be surprised if we ever go below 60K again. Now, maybe the next bear market bottom, somehow we get back and we have a black swan coincide and somehow we get back to 60K or below it. But I'd be shocked. I actually think that we'll never see below 60K again once we break 80. That's just my take. Don't trade on that. But yeah, that's just how long we've been here, how strong we built this. And when we break 80, I think we're gonna start to see, yeah, it's gonna be the kind of no return.
You can you can definitely feel the crab crawl fatigue in the community online. So I think this is
the
way
that's pretty much it. Unless you guys want to add to it.
Yeah, there's a lot to look forward to if people can stay the course and accumulate. The worst that can happen is something that brings us back closer to the trend, which is just nothing but opportunity for us. But nothing has catastrophically broken this thing. So,
and on a funny note, I spelled psychological levels wrong. It was a typo, and so in my comment section, I was getting a lot of seaweed comments because I guess that's the study of seaweed. So there's people.
Oh my gosh,
seaweed pictures. It's the study of seaweed. So this is the seaweed levels. Yeah.
I'll end on a positive note. Like, even though this has been a consolidation range and it's actually a downward sloping channel if you look closely, but as the gentlemen were talking about earlier, the fair value is doing this. Okay, so doesn't really matter how long we spend in this range. The fair value is going up, and it's just giving you more time to accumulate and then catch up really rapidly after that. So this is awesome. This is awesome.
Well, when would you guys get concerned, I guess? Like, when would you kind of say, okay, we're no longer in this healthy consolidation range? Like, if we had a sustainable break below 50K, like, what would you guys say? Like, I'm not a TA guy, really. I follow other models, but I guess, where would you guys start to kind of say, okay, maybe this time is actually different?
So for me, it all comes back to fundamentals. If Bitcoin is working the way it's supposed to be, and the 21 million cap is intact, and fiat money is growing, there's absolutely no way Bitcoin is not going to grow with it. The only reason we might break to some crazy, scary low level is if too many people panic. And if I see that panic, that tells me that we are under positioned. So I actually won't get scared. But if no one is panicked and we are so low, actually that's bad. So you want to see sentiment gets very, very negative. Few people are positioned at that point, and everything else on fundamentals are doing well. That's awesome. But if suddenly governments become responsible, I'll be worried about Bitcoin.
Yeah, right. That's good.
I'm the same. If gold creeps up a lot because governments are not being responsible, I'm not worried, because Bitcoin eventually will do the same, and as we know, much more. And if it's the opposite, then there's some reason to be concerned. But there's no indication at all that they're not going to crank out the printing presses more in the next cycle.
Yeah, I agree. I couldn't have said that better myself. The only thing I would add is, from the math perspective, I think we've talked about more of a catastrophic failure might be over some period of time, seeing a trend, like a meaningful change in the trends that we've seen with the correlation to the model. So
yeah, if we start to see like the power law break down, the R squared going below like 0.9.
Yeah, maybe signs of a phase shift, right? Which I know has been a hypothetical discussion for the future, but
right. Yeah. Maybe the last chart, just the quantile one.
Sorry, I thought we were
very last chart. Yeah, very last chart.
So. Yes, I'm confusing my buttons here. All right.
Yeah, so for this one we've talked about previous weeks, so I'll be really quick on it. And this is a zoomed out view, right? So the goal is to have this on a more zoomed in version, and we're going to work on this as a team. So like Svensson and Sina and me are all going to kind of put our heads together and really figure out how we can utilize this quantile regression channel, not only to make sure it's valid, meaning, it is valid, but make sure that it's useful, right? So making sure that we're not seeing, again, it comes down to how stable are those and how predictable into the future can those top quantiles be. And we need to really quantify the change over time and how predictive those quantiles can actually be. Because I do think that Svensson's concerns about it being potentially over basically saying that the prices we get to are a little bit on the high side. Like we might not reach those upper quantiles, but basically where the model is at right now, this is showing the things that I think are the most relevant quantiles. And I just wanted to have a zoomed out visual of this, and then we'll do like more zoomed in visuals. And what the goal is to have is to like the long term goal is to really have this so that we show the next year, maybe the next year to 18 months, and we break it down by quarters and ranges of time. And then we can break down like the probability of reaching certain quantiles and really dial it in. But right now, just to show it, so we have like on the bottom there, that's the 0.1 to fifth quantile. So that what that means is the very bottom blue line there, only 0.1% of the time are we ever below that line, just so people that might be joining new this week. That means 1 in every 1,000 days. This is daily data. We're going to use hourly and 10-minute data in the future, but this is just daily. So, but only 1 out of every 1,000 days do we ever go below that bottom blue line. So it's extremely rare. I mean, it's really only black swans, extreme black swans, that have ever brought us into that bottom band. And then the fifth quantile means, again, like 5% of the data points or 5% of the days are below that level. So we only spend 5% of the days below that second blue band. So that bottom 5% really gives us a period that's been, the most extreme events in Bitcoin, right? If you look at it, it's the FTX Luna collapse, it's the COVID collapse. We actually didn't even get to that range during the bear market low of 2018, 2019. We didn't quite get there. And then, previous bear markets. And then on the higher side, the interesting thing is, there's different ranges. So I wanted to put everywhere between 90 and 99.9, because I do think the top 10% of the data set is most likely where we'll end up having a peak. I mean, I wanted to include 80 and higher, like the top 20%, but I just don't see how we don't get above 90%. That's just my perspective on it. I just don't see how, the reason why is because if we're not even in the 10% of the data set to the upside, I don't see how we don't have an unsustainable blow-off peak. But, I mean, you could include maybe 80 and above in future ones. But I do think we'll get to probably 90 or higher. That's my take on it. Now, there's quite a range there between the 90 and the 99.9. That's something worth noting. So I'll just quickly give the numbers. And this is only based on today, right? So this is today. So just to quickly to go over some numbers. So today we're at, I made this model yesterday. So we're at 63K. So let's just use 63. So 63 is actually the 44.7th quantile, right? So that's 53K. We're at the 44.7th quantile. And then the bottom numbers, and this is relevant because this is power law support, right? So I like to look at power law support as kind of anywhere between the 0.1 and the fifth quantile. So that's 34K to 41K. So that's kind of like worst case scenario in my view. If we got a black swan over the next month or two, say something around the elections, I don't want to manifest things, but say there was some crazy black swan that occurred in the world for whatever reason, and it brought us down to kind of like an extreme fear event, then I mean, it's realistic to think, or kind of just on the downside risk, we could go down to say on a worst case scenario. And again, these models can, we could dip below them. I don't want to say like for sure this is the range, but this would be kind of worst case, like 34 to 41 is kind of showing the power law support. That's where we're at right now based on this model. And then to the upside, this again is just based on today. So the 99.9 is at 237,000. The 99 is 202,000. 95 is 176,000, and then 90 is 144,000, right? And so that's based on today, but this increases every day. And so, depending on when we actually peak, those ranges will be higher. So that's kind of how the model works. And we're going to over time kind of fine tune it and see how useful it can be. But I think it's a good way to look at it because you're essentially saying like what percentage of the days have we been above this period, or what percentage of the days have we been below? And like right now we're at 44 quantile. So 44% of the days we've been below where we're at right now, and 56% of the days we've been above where we're at right now. So we're just kind of in the middle of the data set, right? That's what we've been talking about. And when we start to get above 80, 90, it's like, okay, we're in the top 10%, we're in the top 20%. This is when you want to start paying attention. And then everyone has to make their own decisions. We don't give financial advice. We just present data. But everyone has to decide what they want to do, right? We know over the long term, like we showed in those other models. I mean, the fair value is $1 million in 2034. So do you want to risk selling? I mean, anytime you sell, there's no guarantee you'll ever get back in at that price again. So I look at these models as useful for when, say in the future, somebody wants to take some lifestyle tips off the table. This gives you a way of saying, am I getting good value, right? Like if I'm selling in the top 10 or 20% of the data set or 5% of the data set, I know at least I'm getting good value if I'm selling for some lifestyle reasons in the future. Say it's a couple cycles from now or next cycle. Everyone has to decide what makes sense for them. But at least you're not selling in the bottom 5% of the data set, right? Like that's really the way to look at it. Like you don't want to be selling when we're in the lower ends of the data set. So anyways, that's basically it.
Awesome.
Nice
Very good.
work.
Very good.
Thanks, Clancy.
Nice work, everyone. And we'll continue working on this. And I hope we can write something more detailed about it at some point. It's just a matter of finding time. Maybe an article that explains this in more detail, and put it up live on a website as well. So that's coming. Thanks a lot, gentlemen, for the presentation. And I also do want to especially thank Matthew for showing up with his mesmerizing voice and high quality video and audio. So thanks a lot for joining and bringing your work and analysis. And we look forward to seeing more of you.
Thank you, guys. I hope to come back soon, very soon. Keep
up
the great work.
What's the best place to follow you, Matthew, for people that are watching? Like, what's the best place to continue to see your content? Because it's great stuff.
Yep. Thank you very much. At any platform, you can find my username is @OneBaseMoney, @OneBaseMoney, and my website is porkopolis.io or basemoney.io, cryptovoices.com. You can find it in my different places, but porkopolis.io/thechart is where I do a lot of the power curve work there as well.
And your charts are getting an update.
Yeah, I mean, there's not going to be as much as I put out on YouTube, but on YouTube and X, I'm putting videos now out on X as well. So you can see all of the videos. They're coming out a couple times a week, 2-3 times a week. I'm putting out videos covering pretty much what I covered today with you guys.
Yeah, you can find Matthew on big podcasts as well. As I said, I have the one you did with Peter McCormack just on the watch list. After this one, I'll go listen to that one. So I highly recommend.
Thank you, guys. I really appreciate it. And yeah, really, it's nice to finally, after a lot of years, just kind of, you feel like you're doing some of the stuff in the darkness, and then you find some people that really grasp and of course, even at a higher pedigree than me, which is great, that can, steer me in the right direction when I'm trying to look at fitting some of these curves. But doing it in a mathematical and precise way, it's fun.
Yeah, it's nerds unite for sure. Bitcoin nerds unite here. We're finding our tribe. It's cool.
Yeah, it's been great chemistry. It's been a lot of fun having you on, Matthew. Thanks for joining us. We're doing this again for sure.
Thanks. Appreciate it.
Okay, guys. Anything else, or are we good to close this one?
Yeah, I think we're good to close it. I appreciate everyone watching, tuning in, and yeah, if you tuned in later, like this is live on X, so if you're tuned in late, then we'll be up. Well, you can go back and watch the full thing, of course, and we'll upload the full thing as well.
And keep looking for the BBD show weekly. Yeah,
BBD. Yes.
BBD.
So our latest number is 3,200 views, and they're coming from all the channels that we are streaming to. So thanks a lot for being with us, everyone. Appreciate your attention, and follow us for the next episodes.
Thanks, everyone.
Thanks, guys. Have a great week.
Take care.
We'll see you.
Have a great
weekend
weekend
next week here.
Yeah, take care, guys. Good Saturday.